Welcome back. In this video, we're going to talk about aging accounts receivable. Don't worry if you didn't cover this in Accounting 100. It's an appendix that some instructors do not cover. So because of that, my plan is to walk you step by step through the process and help you with the journal entries that are required on the problem. So let's get started. As always, you should be in the Canvas module and you should have found the directions and printed them out. In addition, you should have downloaded the Excel file, and this video will help you complete the assignment. If you do find that you need additional help, as always, all you have to do is ask and reach out to either myself or to a classmate through the discussion board. You can reach out to me through email or by coming to my office hours. The objectives of this problem is to be able to prepare an accounts receivable aging schedule, to apply the allowance method of accounting for uncollectible accounts, to apply the percentage of sales of accounting for uncollectible accounts, to be able to alter a file to include new customers, and of course to create a chart. Let's talk about a brief overview of what an accounts receivable aging is and what it's used for. So as you know, accounts receivables are created when we sell our goods or services on account. Generally Accepted Accounting Principles, or GAAP, tells us that the expenses of the period need to be reported in the same period as the related sales. We call this in accounting the matching principle. GAAP does provide several methods for us to do so. One of the methods is called the Allowance Method, that's based on an aging of the accounts receivable. In this video, we will also demonstrate a short percentage of sales calculation as well. And by following one of these GAAP methods, it ensures that we record the related expense in the same period as the sale. This means that we're in accordance with the matching principle, and by doing so, we also bring the value of the accounts down to their NRV, or net realizable value. In accounting, we always need to keep in consideration the matching principle, but we also need to do it with respect to the materiality constraint. So the matching principle once again says that the expense recognition requires that expenses be reported in the same accounting period as the sales that they helped produce. The materiality constraint states that an amount can be ignored if its effect on the financial statement is unimportant to users' business decisions. Of course, you have to go through the hassle of computing adjustments before you know if they're material. The allowance method that we're going to be demonstrating today tells us that at the end of each period, we need to estimate the total bad debts expected to be realized from that period's sales. The allowance method, which is only one of the methods that GAAP allows us to use, has two advantages to it. It records the estimated bad debt expense in the period when the related sales are recorded, and it also records accounts receivable on the balance sheet at the estimated amount of cash to be collected. Again, the technical term for this is NRV, or net realizable value. So when we follow the aging of receivables method, the first thing we do is we classify each receivable by how long it is past due. And then each age group is multiplied by its estimated bad debts percentage. This percentage can come from a company's own past history, and it can also be tweaked for things such as economic conditions or how the economy is behaving. Once we do that, we estimate the bad debts for each group, and we total them up. So on the screen is an example of an aging. On the left-hand side, you can see that each customer account is listed, and each amount is split out according to how old it is. So for example, in this first one, Carlos Abbott's account, he owes us a total of $5,890, but when they aged that invoice or invoices out, the whole thing is not yet due. That means that the percentage uncollectible is going to be relatively small. You'll notice that the older something gets and the more it moves to the right in the past due accounts, the higher the percentages of uncollectability go. So in an aging, we age each customer's receivable into the appropriate accounting category, and then we total up each age group, and we apply predetermined percents uncollectible. We multiply the two out, and when we take the results of all the various columns, we add them up to get the total estimated uncollectible accounts. In this short example, they had accounts receivable valued at cost on the books at $50,000, and they're estimating that based on those $50,000, $2,270 of accounts will not be collectible. So in this case, it looks like the allowance account, which by the way is a contra asset account, has a balance, a beginning balance in this case, of a credit of $200. And based on the aging that we just performed, we estimated that the balance in that account should be $2,270. So what it takes to bring that balance from a current credit of $200 up to a value of $2,270 is an adjustment of $2,070. The adjustment is a journal entry that debits the bad debt expense and credits the allowance for doubtful accounts. Normally, a contra asset account will have a credit balance. However, there are times where if an estimate is not made properly, you may have a debit balance in that account. And what that means is that you had more write-offs than what you accounted for in the previous fiscal period. So let's address that scenario next. In this case, based on the same aging, here's the $2,270 that we just saw, but in this case, the balance in the allowance account is a debit. And again, that would come from an estimation or a lack of judgment or a lack of precision judgment in the previous quarter or fiscal year. So in this case, there's a debit balance. We need to bring it up to a credit balance of $2,270, so we would add those two together to come up with the proper adjustment. You might want to pause this and take a look at that slide for a little bit longer to make sure you understand it. So let's get down to the nitty-gritty and look at our Excel spreadsheet. So here's our Excel spreadsheet that you should have downloaded. You'll notice that there's a list of customers here in alphabetical order, and you'll notice that for each customer they have the total amount due in the total column, and they've taken each of those line items and they've aged them out according to how old they are. They've also provided you with the predetermined percentages in your instructions, or here they are again recorded here. So our job is to take the amounts that are in each column of the aging category and apply these uncollectible percentages. For example, the not yet due amounts for Formula 1, I would press equals and I would go grab that amount. Here it is in the not yet due column. I'm going to click it and press enter. And for formula 2, I'm going to do the same thing. I'm going to press equals. I'm going to grab the 1 to 30 days past due here and press enter. Then I'm going to go grab for formula 3 the 31 to 60 days past due and press enter. I'll do the same thing with formula 4. I'll go grab the 61 to 90 days past due. Once I can scroll up here. Click on the cell I-22 and press enter, and go grab the over 90 days past due by going up and grabbing that last column and pressing enter. And the total amount of the receivables when I foot them, when I sum these up, should balance to the total amount of accounts receivable in our template. In other words, make sure that the total amount here, I'll put this in a different color so you can see it, make sure that that amount of $42,800 in our case matches this $42,800 over here, especially as you manipulate the template later on. So for the total uncollectible, we're going to be taking the amount in the category, in the aged category, multiplied by the percentage given. Press that in there and press enter. Now you can enter all those formulas individually, or you can use a little fill handle and grab that first formula and copy it down. Didn't grab it quite far enough. Let me go down one more. And then for formula 12, we're going to sum those up. And that should match the number given to you in your check figure. Once again, let me put that in a different color so you can see it. Okay, let's address some of the journal entries in the third requirement on your handout. So here is the balance that we received, or that we calculated, that the allowance account should be. So I'm going to put that in a T account that I created up here. Let me unfreeze these accounts so I can scroll up. So over here I've put a T account so that we can visually see what's happened. And we just calculated the balance that should be in our allowance account to be $2,387.50. Let me highlight that so you can see it. In the first scenario, the requirement states that we had an $800 beginning balance, and we want our balance to be equal to what we calculated on our aging. So the adjusting journal entry that we would have to make that happen is the difference between those two accounts. Let me pop that in there. In this case, our adjustment needs to be for the amount shown. Let me highlight that in another color so you can see it. The journal entry to record that, which your paper will ask you to record, is a debit to uncollectible accounts expense, or it could be another account name like bad debt expense. But in any case, it's some sort of an expense. And the credit is to the allowance account that you see on your screen. Let me scroll over here. The credit would be to the allowance for bad debt, or allowance for doubtful accounts. And our adjustment would be for the amount we computed, which is $1,587.50. Okay, and of course, whenever we make an adjusting journal entry, we always leave a very good description of why that was made. To record the adjustment to bring our allowance account from an $800 credit balance to $2,387.50 as shown on the aging. So that sounds like a pretty good description. In the other requirement, what hasn't changed is the amount that the ending balance should be. Okay, again, let me highlight it so you can easily see it. But in this case, we started with a debit balance, and again, that could happen when we write off more than we estimated. So that would be a carryover from last year's little mishap on judgment. And to calculate the current adjusting entry again, instead of subtracting like we did on the previous T account, in this case, to get this to foot, we would be adding them. So once again, let me highlight that in a different color so you can see it. And the journal entry would be the exact same journal entry that we did here. But of course the amount would change. So let me get that in there. Again, don't worry about it if you didn't cover this. In Accounting 100, it was an appendix, so some people didn't cover it. That's why I'm spending the time to do the journal entries with you. Let me format this to look like the other one. And again, I'm not going to take the time to write a description, but you should write another brief description. Okay, so far we've covered journal entries under the aging method using the allowance for doubtful accounts based on two scenarios. One where our account had a starting credit balance, and then in requirement 3B we took a look at a scenario where the allowance account had a debit balance. Requirement 3C says let's change and forget about the aging method. Instead, let's use another GAAP acceptable method called the percentage of sales. This method completely ignores any balance that exists in the allowance account and just makes the adjustment for the current year's sales only, which is different. The allowance method looks at all the accounts receivable that's sitting on the balance sheet, no matter how old they are. But the percentage of sales method only looks at the current year sales, and it multiplies it by a set percentage. And that percentage, again, would have to be calculated by looking at the company's past history as well as taking into account any economics considerations. So in 3C, it says that uncollectible accounts are estimated at 2% of sales. So we would go ahead and take the December's credit sales and take 2% of that. So it looks like they're making the journal entry monthly. So let's assume we're making this for December. We would take $84,000 and we would multiply it by the 2%. And when we do that, we'll come up with the amount of the adjustment. So 84,000 times 2%. I pop that into my computer or calculator. I get 1,680. And again, I would make the same debit and credit account, but the amount completely ignores the existence of any allowance account. So I would make this journal entry for 1,680. And again, I would put a description in showing how I calculated it as part of the description process. And that, I hope, will help you with the accounting needed for this. So we've done the aging together. We've done the journal entries together. You guys have a couple of other problems, but I've done most of this problem with you, so I expect you to do really well. I have some formatting issues to clean up. I need to make this neater. I need to go in and put my descriptions, but overall, that's a good overview of what I expect you to do. So, as always, make sure you complete the problem according to the directions. I keep begging you to double check the requirements. Before you upload the file, the final file to me, Double check to make sure you've met all the requirements. Make sure your work prints out properly. If the work needs to be on several pages, you need to split it in appropriate places. After double checking that you've completed all parts of the problem, upload the file, the one final file, to me through Canvas. Make sure that each week you check to make sure if there is any discussion post required. If you need help, you have to reach out. Don't suffer in silence. Reach out, ask myself or one of your classmates a question. And as always, I'm here to help. All you got to do is ask. Until next time, see you later.